Okay, so this is a REIT. It's publicly traded. I actually know it because I invested myself personally in this particular REIT. It's called Whitestone. They own properties in Texas, mainly Houston and Dallas-Fort Worth area. Anyway, this is an interesting REIT. It's much, much smaller. But what's good about it is, and you can see here, it's got a good, healthy dividend. It's paying 8%. And so right now, that would be a very, very high dividend compared to most. I think the average REIT right now is only paying 3 to 4% dividend. Yeah.
Is there any way to invest in a REIT with 401k?
Yes, and you're allowed, as long as you can open a brokerage account, you can buy a REIT, right? So if you have a brokerage account, Schwab account or Fidelity, whatever, in your IRA or 401k or whatever, you're allowed to buy a REIT. So like I said, this is one that's paying 8% and it's going to pay monthly and you're going to get that dividend.
How
Now,
big is this one?
Sorry?
How big is this REIT?
I'm not sure. It's
I shouldn't say that.
somewhere. Volume. I mean, it's definitely less than $1 billion. It's in the hundreds of millions, which in the REIT world is small. So this is a smaller one, but you can see that their share price goes up and down quite a bit. So this one is not really as well known, and it's going to be more volatile. So that is one risk. And again, we talked about interest rates, right? If interest rates go up, and you're in a REIT that's paying 3%, and CDs go up to 3 or 4%, which one are you going to want to be in, a REIT or CD?
It's on top of their market cap, whatever it is.
Is it?
Five something.
Company to look. I'm not sure, but we can look it up. But the main thing here is that if interest rates go up, REITs and bonds, for that matter, will go down in value because you can go and get new interest rate or new investments at the higher interest rate, whereas the old one becomes less value because it's at a lower rate. That makes sense? Like if you bought a bond that was paying 3% and then interest rates went up to 4%, how many people want your 3% bond? Exactly, it makes it less attractive. Same thing with REITs. If you buy a REIT today that's paying 3% and interest rates go up, then that REIT share price will probably go down. But the vice versa, if you buy a REIT that's paying 4% and then interest rates go down, that will make that REIT go up in value. And the same thing with bonds. You buy a bond today paying 4%, interest rates go down to 3%, that makes your 4% bond more valuable, right? And so that bond will go up in value. So they go the opposite of interest rates as far as the value. And believe it or not, guys, real estate is very similar. Same kind of rule, and I'll explain that more in a minute. But anyway, I just wanted to show you that there's, that's a REIT. Another one that I know of, and this one, like I said, is mostly commercial buildings. Another one that I was involved in years ago, HTA, healthcare. This is sorry, flip this up a bit. Healthcare Trust of America. We go back 5 years here. You can see the prices bounce around a bit, but they invest in medical buildings all over the United States. And I like medical a lot because medical is a nice low-risk area. When we had the last recession, medical was the only industry that kept growing in the recession. So it's a good bet. Anyway, so this one's a little more conservative. It's probably normal for a REIT right now. It's paying a 4% dividend. But this one went up quite a bit. When we were dealing with it, it was back here, and the price went up quite a bit. Actually, what happened here was I was raising money for the non-traded REIT, and then they went public. And then we actually did really good when it went public because the REIT was paying 6 or 7%, and then when public, that made it really attractive, and it got bid up, and now you can see it's paying 4%. So same idea. If you have something that's paying a higher than normal interest or cash flow, everybody wants it and pushes the price up. Yes?
So if we go through a recession, which we will eventually, the rates aren't going up, they're going down. In medical, chances are.
Exactly. Again, if you're in a low-risk investment, which in medical I would consider that on the lower end of the risk, as far as property goes, then yeah, you're right. That would make that, it would hold up real well through a recession, should anyway, and also it should go up in value. And you can see here at the tail end, in the last few, this is probably this first part of this year, interest rates went down, right? And what happened to the REIT? Value went up.
self-directed IRA into a REIT?
Yes, as long, any brokerage account, you know, it's a stock. So anything you can buy a stock in, you can buy the REITs in, because you're buying shares in it. Yeah, so that's another example. I'll just show you one more, another one that I know about. I actually have shares. Should disclose I have shares in this one as well. Here we go. Company called Blue Rock. I've dealt with them for many years. They have an apartment REIT, and their share price now, and again, there's risk here, guys. You know, we have to understand, if you're buying a REIT, you know, it's gonna reflect the real estate, it's also gonna reflect the management of the company, and it's gonna reflect what's happening with the property. So you can see that this has actually bounced around quite a bit. This was up around $14 a share, went all the way down to actually $7 at one point, and now it's been climbing back up. Right now it's about almost $12 a share. Right now it's paying a 5% dividend. So that one, again, it's smaller. They're in the process of building it up, and it's been fairly volatile actually for that type of REIT. Yes?
So the problems of self-management within a self-directed IRA could be solved by investing with REITs if you're not dealing with self-management.
You mean as far as?
So if you had a rental property out of, and you would try to manage that rental property yourself, in
Right.
an IRA, self-directed IRA, you can't do it, you're not supposed to, it's illegal or something?
Well, to answer that question, and we do it, you can buy a property in an IRA,
Right.
but you can't get debt on it. Or it's really complicated getting debt. So if you're gonna buy a property, and again, we do it all the time, you can buy it inside of an IRA, but you need to pay all cash, okay? And then it has to be, you know, an arm's length transaction. You can't be something you live in, but you can buy a rental property and own it in a REIT, or sorry, in an IRA. That's not a
It's something
problem.
that you can't self-manage, in other words, you can't be the property manager of that.
Oh, I see what you're saying. Yes, yeah, you need to have outside management and stuff.
So this makes it much easier to do a REIT than an IRA, it would be to try to manage.
Right, now I see what you're getting. Yeah, exactly. So buying a REIT, you don't have any self-management issues at all. You're just the guy buying and selling the shares of that REIT.
The no-brainer makes it easy.
Correct, yeah.
And you don't know the managers at all.
I mean, in the REIT, probably you don't know them at all. You're right. You're gonna get a little notice who the board of directors are and stuff, but that's about it. Exactly. So anyway, that's pretty much the REIT story. You know, again, there's a lot of different REITs, and just like anything, there's good ones and ones that aren't so good. And if you see one with an unusually high dividend, then you need to, you know, it sounds attractive, but just like if you see a property that seems, you know, way cheaper than it should be, you need to take a good look at it, because there's a good chance there's some issues there that there's a reason why it's got such a high dividend, right? They're trying to attract investors, and it may be there's some issues with the properties or whatever in that REIT. So you do have to take a look at that.
I think Earl's alluding to management is a huge concern when you're investing in REITs, so you better look at the management.
Correct.
Over that REIT.
Exactly, yeah, exactly. Just like anything, you wanna see, you know, bet on the jockey, not on the horse, right? You wanna make sure whoever's managing those properties, they're doing a good job, they're buying them at the right price, they got good property managers that are making sure that the leasing is being taken care of, you know, all that kind of stuff. And there's a lot of money going into REITs right now, because again, you know, a lot of these big institutions are dumping a lot of money in, as well as people that are retiring. I mean, there's something like 10,000 people a day retiring right now in America. And all those people want their money somewhere where they can get some good income, right? Because they're now living off their investments. And so there's a lot of money going into this kind of stuff. And that's one reason why the prices are being pushed up. But they're all going to be looking at the cash flow and you know, how the management's running that REIT, and what kind of properties they're in. Because again, certain properties hold up much better in recession than others. Right?
Yeah, I was just gonna ask a question, I think I just answered myself.
Oh.
What performs better, REITs or general stocks? But in general stocks, if the interest rates are going up, the stocks will be better than REITs.
Yeah, I mean, and again, you know, things come in our favor, you know, and REIT values will change, but they generally are based on the real estate inside the REIT. So and again, they're mostly gonna be commercial real estate or some kind of cash flowing, you know, long-term lease rent. Like right now, okay, give you a great example of the opposite. So right now, because of Amazon and all that stuff going on, retail is out of favor, okay? So there's a company I work with, and they're very good and very smart, and they're busy buying up all these shopping centers that REITs are unloading. Because there's some REITs out there, they're saying, or even some large, you know, institutional portfolios like pensions that, they're saying, look, we've got a bunch of money in shopping centers right now, and the future's not looking good for shopping because of all the stuff with Amazon and the internet. So they're dumping some of their properties to lighten their load, or if they have a particular shopping center they're concerned about, they're selling it. Well, on the other side of the coin, I have a group that I work with out in New York, and they're busy buying up these properties, and they're getting them at like 10% cap rates. And then they'll go in there and reconfigure the shopping center and do different things to it, and then increase the value. Because, look, and I have this conversation a lot with people, you know, it's a big argument, oh, you know, people aren't gonna go shopping anymore. Well, they are. You know, down where we are, I mean, Glendale, there's the Americana, and it's full all the time. And then if you go to Arcadia, the Santa Anita Mall, I go there, and it's hard to get parking spots sometimes. So what's happening to all this retail? It's changed. You know, if you look at those shopping centers, there's a lot more restaurants, they've got movie theaters in there, they got some cool stuff where you can take your kids, eat dinner, go to a movie, hang out, watch waterfalls going, or, you know, water features and all that kind of stuff. And it's become more of a destination kind of thing. And the stores in there tend to be higher end stores that you probably want to go in and try stuff on, or there's the Apple store in there, you know, stuff that you're not going to buy off the internet. You're going to go in and check it out and buy it directly, or there's hair cutting places and the nail, you know. So there's a lot of things that you can put into a shopping center that makes it valuable, and it's bypassing the whole internet thing. And that's happening, but again, you have to be smart enough to understand that market and deal with it. You know, these guys, I saw them buy a property with, in fact, I had some investors go in it, and they bought a shopping center with J.C. Penney in it. And everyone's like, oh my God, J.C. Penney's gonna go broke, you know, why would you buy a building like that? They want J.C. Penney to go. Because what people don't realize is that J.C. Penney was paying really super low rent. And a lot of these big shopping centers, when you have an anchor tenant like that, you know, J.C. Penney or whatever, Sears or whatever it is, they're paying practically nothing for their rent. You know, that was done a lot 20 years ago, and they had long-term leases. And so a lot of those leases are coming up, and these guys are buying up saying, look, you know, we want J.C. Penney out of there, because we can go in there and cut that up and put in some food court and all these other things in there and get 10 times the rent that we were getting from J.C. Penney. And they know how to do that. And then they'll put money into marketing, and they'll get that shopping center up and running and doing really well. So again, you know, there's all these opportunities, and there's, you know, some people that are just can't deal with it, and they just want to get it off their plate. And that happens all the time with different types of assets and different things going on. So anyway, just give you an example that some of the retail, can't think of it off the top of my head, but a lot of the retail REITs are down right now because everybody's scared that no one's going to go shopping again. But I can guarantee you, watching my wife and my stepdaughter and everything else, they're always going to go shopping. You have a question?
Yeah, just a kind of clarification in regards to management. And so a REIT is like a mutual fund, and so in my mind, management would be like a mutual fund manager. Is there also, since they are real estate, there's actual property managers involved. So what does that look like? Does that kind of make sense, my question?
Yeah, well, it's a good question. So he's asking, you know, who's actually managing these properties, really you're getting down to.
Yeah.
I would say most of the ones I've seen, and it can be different in different REITs, some REITs have their own property management company, and they will self-manage all the properties.
Yeah.
Some of them will hire local regional management companies to manage for them, and then they'll be what they call an asset manager and oversee it. So it kind of depends.
Okay.
But I would say most of them have some kind of local management. You know, like apartment complexes, there's some very large national companies that just manage properties, you know, just manage apartment buildings.
And if someone were to research a REIT, is it more important to kind of research the asset manager or like the property management company they are using, or both?
Well, it's a good question. It's going to be hard for you to get a lot of that information, you know, to be honest. So you're probably going to have to go through and look at different REITs and see what their, you know, what kind of cash flow is coming off of them, what kind of properties that they're in, you know, what category, and also look at the track record. You know, see if they've been downtrending or uptrending, or, you know, and also be aware of that, you know, when I showed you that chart earlier, of interest rates have been going down quite a bit over the last 30 years, really. You know, it's been very good for the REIT market, and it's been very good for just about every market with the rates going down like that. Yep.
So in my mind, if the REITs are paying and the rates are down, it seems like people who are just starting off with real estate investing and really don't have money to go out and buy an actual rental. You could place some money to build it up. It would also be good for people who have a career where they just don't have time to deal with real estate and rentals and all that kind of stuff, but they
Right.
need investment. Or for somebody who's like 80 or 90 and not thinking too well and just needs something simple to invest in.
Correct, and REITs are a nice part of the portfolio where you can invest in real estate and not have a lot of money up front or have passive income and not have the management problems personally. And so it's very common for people to have a REIT or REITs as part of their portfolio. And again, I would see a big driver for REITs traditionally is the fact that they have good dividends, which is the rent they're collecting. So it's gonna kind of mirror what's happening with the real estate, rental market to some degree, yeah. Yeah, and then, some people, like I say, they're trying to save up money to buy your own property. Well, you put money into REITs and build it up, and eventually you can cash that out, and you got a down payment on a small building. Yes.
So just like Dan said, like a beginner has like don't have experience, I'll be trying to do this complicated real estate investment stuff, so one might do one of the more easier route with the REITs, so what would be the proper steps to find like a good investment with a REIT?
Yeah, and I don't want to give any recommendations right now. I want to kind of give you the theory of how all this works. And then, if you guys want to have an appointment or something later, or if you want to, just do your own homework, again, I would follow through. You can Google REITs and say, okay, what REITs, for example, I think medical is a good bet, right? Because we are going to have another recession one of these days, right? So medical should hold up, or triple net lease properties should hold up very well in a recession. So anyway, you just need to do a little bit of homework and find out what makes sense. It's a good way of not answering your question, I realize, but.
So it might be saying, can I come to you?
Yeah, you can come, or someone in my office or something to talk to you about it, or some other financial advisor or whatever. There's a lot of different opinions on look, in the end, anything you're investing in is gonna have some risk. And so there's pros and cons to everything. If interest rates go up quite a bit over the next, whatever happens, then REITs are gonna go down in value. And so no matter how good a REIT it is, if rates jump up, that REIT's gonna go down. But just like, rental property will go down as well, so then you have to hang on to it. And like Dan was talking about it, most situations, if you hold on long enough, you're gonna come out the other end and you'll be fine. But you have to have that waiting period.
And once the rates do go up and rates go down, that's the point where the general stock market would be better to invest rather than real estate or REITs.
Probably. Time will tell.
Yeah.
We'll see.
Okay.
I've seen all different things happen that I never expected, so you never know.
No crystal ball here.
Exactly. Main thing is, look, in the end, if you diversify and have an understanding that there's some risk and you have some holding period, it's not money you absolutely need to have, right? It's money that you're saying, okay, I can let it sit, I'll get the dividend off of it, but this is not the money that I need if I lose my job and I need to make a mortgage payment, because it may go down in value. But if I'm gonna hold it long-term, most things tend to be okay. Okay, so I'm gonna change hats here, and, one thing I need to do here real quick. Legally, I have to show you disclosure. I know you can't read it all, but basically it's just saying, look, there's risk in everything. So, whenever you're investing in anything to do with the stock market or any kind of securities, there's pros and cons, so make sure that if you're gonna do it, most investments have a private placement memorandum, and it's gonna be a big, thick thing that's gonna give you all the information and more than you wanna know about any kind of REIT or any kind of mutual fund or any kind of stock or whatever. So that's, they're just saying that you need to do that and get that and make sure you get any questions answered before you invest. Because again, there's pros and cons to everything. All right, I'm gonna change hats now, and I'm gonna talk about real estate. So now I'm wearing my real estate license hat. So again, I have some brokers that work for me. I've been in the same location now for, next year it'll be 20 years in San Marino. And we have full service, and we focus on income property. Okay, that's our big focus. And again, there's all kinds of niches out there. We deal a lot with people that are selling property in LA. It could be a fourplex or 20 units or whatever it is. And then we find them replacement property. And we tend to buy property out of state, not always, but that's kind of where most of our stuff goes. So a lot of the properties we do are off market, people don't realize it, but almost 50% of commercial and that type of market is done off-market. You know, it's not on LoopNet, it's not an MLS. So we have some really good relationships we've developed around the country where we can get access to properties. It's not always off-market, but a lot of times it is. Commercial properties, and we also do investing for clients in real estate in IRAs. So we kind of went over these same slides actually already, so I'm going to skip through these quick. And, sorry, I did this already. Okay, so I'm going to talk next about, all right, so now when we talk about rents. So if you're buying a property, a rental property, and you want to increase the value of that property, how do you do it? What's the goal? Pardon?
Raise the rent?
Exactly. You have to raise the rent, okay? And I'm going to show you some stuff on cap rates in a minute, but a cap rate is a calculation based on how much income you're getting from your rent minus the expenses versus what's the value of that building, okay? And this reflects very closely what I just went over with you about interest rates. So for example, back in the 90s, you could buy apartment buildings in the San Gabriel Valley in LA all day long, paying around 8 or 9% cap rate, okay? And back then, if I would have done a seminar talking about anything paying less than 8%, people would have been really bored, because that was normal back then. So, and again, it was across the board. CDs were paying 6 or 7% back then. You know, bonds were up around 6 or 7%. And again, you'll find that apartment buildings will tend to be a little bit higher return than CDs or bonds. You know, it's gonna, I don't know what the exact ratio is there, but it's gonna be higher because there's more risk in buying an apartment building than there is in buying a CD or a bond. Again, if you were to buy an apartment building in LA back in the 90s, all day long, you could have bought buildings that were paying 8 or 9%, which means you buy $1 million building, after paying your expenses, the rent you're collecting, you would expect to get $80,000 or $90,000 of net income, okay? Anybody know what the average cap rate is in LA right now for apartment buildings?
3, 4.
Between around 3. In the San Gabriel Valley where I am, it's between 2 and 3. Santa Monica, it's probably 1 to 2, right? And some of the other areas, sometimes you see 4 or 5. If you're seeing a cap rate any higher than that, and we see them once in a while, I can almost guarantee you it's a pro forma rate. It's not the actual rate. We see it all the time.
Yeah.
We see, oh my God, my client says, I saw this building and they're advertising 6% cap rate, and you know, we get all the numbers and everything, and no, they're projecting that. They're saying the rents, you know, if you raise your rents to this level, you'll get 6%. It's really a 3.5%. Or they've given us the wrong numbers for the property taxes, right? They gave us the property taxes based on the guy that bought the property 20 years ago.
Right.
They didn't give us the new property taxes when you buy it. So again, when you see a higher cap rate, at least in our market, there's something going on there. You know, they're not giving you all the information, or they didn't give you all the expenses they should have. I mean, we run into it all the time. So you really do have to dig into numbers. Okay, so with that in mind, I actually saw or heard a radio thing earlier this year, and they were talking about Los Angeles is now officially the most expensive city in America to live in based on the median income. Okay? So we all know that the rent in the Bay Area or in New York is way higher than LA. Okay? I have friends in New York and I cannot believe what they pay in rent. It's ridiculous. But guess what? They make way more money in New York, Manhattan, than they do here, the average person. And you go to the Bay or Silicon Valley. I had a buddy who was up there a couple of weeks ago. He called me and said, I can't believe this. I was just at a Best Western and it cost me $600 a night. and the market up there is, you know, out the roof. Okay? But again, people make a lot more money up there. They do. And so I found a chart that showed this. And so this red line is LA. The blue line is New York. And so right now, when you take the rent and you factor it and you do a ratio against the average income that people make, LA is head and shoulders above every other city in America. So what does that tell you? If you want to buy an apartment building and you want to increase the value of that building, and you're buying it at, let's just say, a 3% cap rate, the only way you're going to be able to sell that building later and make a profit is to do what? You need to raise the rents, okay? if the rent in LA is already the highest in the country compared to the income people have, how much higher can you raise that rent? I don't know. This is the big question. You know, and I have a bunch of kids that live in, you know, the LA and Hollywood area, and I mean, if you go to the Los Feliz area, I don't know if you know the area, but anyway, it's you can easily spend $3,500 for a 2-bedroom apartment right now. Okay, now right now the economy's doing really well, right? And a lot of these younger people are making good money, and they, you know, 2 people get in there and they can split it and they can afford it. But again, you know, when our rents are higher than everybody else and the economy slows down, how many of those people are going to afford those kind of rents? I don't know. Again, time will tell. You know, this is all questions you have to look at. So, you know, again, when you're talking about multifamily and rental property, you really got to be careful because, you know, again, I'm dealing with people that I mean, look, in LA, you could probably pick any property in LA market, and it's probably doubled in value in the last 8 years. And there's actually some markets that have tripled. I did a transaction with a woman a year ago. She had a property down at Venice Beach. She bought it in 2009, and that property actually tripled in value. I was surprised. Yes.
If you wanted to ask this, but what do you suppose is going to happen to value of these multifamily commercial properties now that the rent control laws have been passed in California?
Yeah, well, that's another slide. We're coming to that. That's another headwind. We'll come down in a minute. But the main point I want to hammer home is when you're buying a property and it's the highest rents ever, and it's higher than everybody else's, and the only way to increase the value of that building is to increase the rents, you got to be careful. And again, you know, I'm dealing with people that are selling property right now and going, oh my gosh, I cannot believe the value I'm getting. I never expected this building to be worth this much. They bought it 10, 20, 30 years ago, and it's just gone up the roof. So that's great. So you sell the property at this top of the market, but then when you go to buy another one, you're buying into the top of the market. And that's where you have to be really careful. And so obviously if you can find a property where the rents are way below market, and you can go in there and do something to, you know, upgrade those units, and then, you know, get higher rent for it, you know, that's where the value is. But that's getting harder and harder to do, because guess what? Are you the only guys trying to do that? Believe me, there's a lot of money out there on every level. We're talking about, you know, 500 unit buildings or duplexes. Everybody's out there trying to buy rental properties. And it's not just Los Angeles, okay? I've been around a bunch of cities in America, and it's all over. And we've tried to buy properties for clients, or we have bought properties for clients in other markets. And virtually every major city right now, when it comes to multifamily, there's a lot of attention, a lot of money, and there's a lot of bids in those properties. I don't care what market you're in. And I mean, you name it, any major city, there's a lot of money going into multifamily, pushing the prices up. Now, you are going to get much better cap rates in other cities than you will in Los Angeles, but again, you have to look, what's the cap rates normally in that market, and then is it, you know, how much higher can you raise the rents in your property? So you got to be careful. This is showing mortgage affordability. Again, LA's #1 in the country compared to, you know, average income, and also price to income ratios when you're buying a house, residential. So again, you know, when we're highest in the country, you have to ask yourself, how much higher can it go? Could go more, but I don't know. And then Dan brought up the thing about rent control. Somebody sent me this about a month ago. These are all the bills that are being debated at Sacramento. I know you can't read it, they're small. But it just goes to show you how much stuff is happening that are either tenant rights issues or rent control, right? Now there was a bill, and I haven't really had a chance to go through it, that was just passed about a week ago here in there was a statewide issue in California. But again, if you're thinking of buying a property and the only way to increase the value of that property is to raise the rents, and you've got all this headwind against you as far as all these issues that are, you know, keeping you from raising your rent, then you have to be careful. Now this is a great chart, or not really, and the yellow states are the only states that have rent control. So again, you know, here in California, and a lot of people I deal with, they're kind of like California-centric, right? But the truth is, we're the outlier. The rest of America doesn't have rent control. It's unusual, okay? So like I said, Oregon just passed a statewide rent control. California actually passed it since this was. And then certain cities, like obviously